Drake and Daniel toured the same apartment on the same day for the same rent. Drake needed a cosigner and a 3-month deposit. Daniel got approved on the spot and skipped the deposit entirely. Same apartment, same income, roughly, one 3-digit number was different. Today we're breaking down exactly how landlords treat renters at every credit score tier. What else beyond the score actually factors in? What to do if you're denied? And how to build credit from scratch if you don't have a score yet at all. Most landlords and property managers pull a version of your FICO score, typically through a tenant screening service ranging from 300 to 850. It's not the only factor. Income, rental history, and references matter too. But the score is usually the first filter, often before a landlord even looks at anything else. Before we get into the score tiers, it's worth being clear that credit score isn't the only input. 3 other things routinely matter just as much, sometimes more. The most common rule of thumb, gross monthly income, at least 3 times the monthly rent. A landlord may waive a soft credit score if this ratio is comfortably met, and may deny an applicant with an excellent score if income relative to rent looks thin. Rental history is the second factor. A prior eviction or a pattern of late rent payments, visible through a tenant screening report separate from a credit bureau report, can outweigh a good credit score entirely, since it speaks directly to the exact behavior a landlord cares about. This is actually part of why Drake, despite his borderline score, still got approved rather than declined outright. His income relative to the rent was comfortably above that 3 times threshold, and he had no negative rental history at all. The score tiers in this video describe a common pattern, not a rigid rule that overrides everything else. Tier 1, below 600. At this range, outright approval is uncommon on its own. Landlords frequently ask for a cosigner or guarantor, proof of significantly higher income relative to rent, or decline the application outright in a competitive market. This isn't necessarily permanent or personal. It's the landlord managing the statistical risk that a lower score represents across many past renters, not a judgment about this specific applicant. Tier 2, 600 to 619. Approval becomes possible but usually conditional. A landlord might ask for a security deposit of 2 to 3 months' rent instead of the standard 1 month, or request a cosigner, particularly for a more competitive unit. Tier 3, 620 to 679. This is the range most commonly cited as the minimum a landlord looks for, and it's genuinely borderline. Some landlords approve without conditions, others still request a modest additional deposit or proof of stable income. This is roughly where Drake landed, approved, but with a slightly heavier upfront cost than someone with a stronger score would pay for the identical unit. Tier 4, 680 to 699. This range typically clears most standard screening thresholds without extra conditions: a single month's deposit, no cosigner requirement, straightforward approval in most markets. Tier 5, 700 and above. At this range, landlords in many markets approve quickly, sometimes waiving the security deposit entirely or offering more flexible lease terms, because a score this high statistically correlates with reliable on-time payment. This is Daniel's tier, and it's the actual reason he skipped the deposit that Drake had to pay. If an application is denied because of information in a credit or tenant screening report, U.S. law requires the landlord to provide what's called an adverse action notice, telling you which reporting company was used and that you have the right to a free copy of that report. This matters because screening reports do contain errors, a payment misreported as late, an account that isn't actually yours, an eviction record that was actually dismissed. If something on the report looks wrong, you have the right to dispute it directly with the reporting company, which is generally required to investigate within a set time frame. Daniel's approach is proactive rather than reactive, checking his own credit report periodically before ever submitting a rental application, specifically to catch and dispute errors early rather than discovering them in a denial letter. Everything so far assumes you already have a credit score, but a genuinely common situation, especially for young renters, recent immigrants, or anyone who simply avoided credit, is having a thin file, meaning too little credit history for a score to even be calculated. There are several accessible ways to start building one. A secured credit card requires a cash deposit that becomes your credit limit, which sharply limits the lender's risk and makes approval realistic even with no history at all, used responsibly and paid in full. It reports payment history the same as any other card. A credit builder loan works in reverse of a normal loan. The loan amount sits in a locked account while you make payments into it and only becomes available to you at the end, with your on-time payments reported the whole way through. Becoming an authorized user on a family member's older. Well-managed credit card can also add that account's history to your own file, if the card issuer reports authorized users to the credit bureaus. There's also a more direct option specific to renting. Some rent reporting services will report your on-time rent payments to the credit bureaus, something Rent doesn't do automatically in most cases, turning a payment you're already making anyway into credit history. None of these require a lump sum of savings or perfect financial history to start. They require picking one option and giving it time, since the biggest single factor in most scoring models is exactly that: time, combined with consistent on-time payment. 4 things move an existing credit score more than anything else, and none of them require a lump sum of cash. 1. Payment history. Pay every bill on time. Every time. This is typically the single largest factor in most scoring models. 2. Credit utilization. Keep balances on revolving credit well below the limit, ideally under 30%, even if you pay in full every month. 3. Length of credit history. Older accounts help the score, which is why closing your oldest credit card is usually a mistake even if you stop using it. 4. Avoid opening new credit accounts right before a rental application. Each hard inquiry causes a small, temporary dip exactly when you need the score at its highest. Drake almost closed his oldest card to simplify. Learning this stopped him. That account was quietly helping his score just by existing. The score isn't the whole application. Income to rent ratio and rental history matter just as much, sometimes more. Below 600, conditional or declined. 600 to 619 possible, with a larger deposit. 620 to 679, borderline. Often approved with modest conditions. 680 to 699, standard approval. 700 plus, fast approval, sometimes with the deposit waived. If you're denied, you have real rights to see and dispute what's in that report. And if you have no score at all yet, there are accessible, low-cost ways to start building one today. This video is for educational purposes only and is not personalized financial advice. Credit score tiers and landlord practices described here are common industry patterns, not universal law. Actual requirements vary by landlord, property type, and state, and some states legally cap maximum security deposits regardless of credit score. Verify current practices with a local landlord or tenant rights resource and current FCRA rights at consumerfinance.gov before applying or disputing. If this explained why your last application went the way it did, subscribe. New videos every week on the personal finance topics school never covered. Next up, Drake gets a bonus the exact same size as one of Daniel's dividend checks. And what happens to each of them tells you almost everything about building wealth.